Every time you notice prices inching higher, you're seeing more than just a number on a label. You're seeing a quiet trade-off in your life. Groceries, rent, gas, healthcare, they creep upward in a steady rhythm. And if you feel like your salary, no matter how hard you work, just doesn't stretch like it did a few years ago, you're not imagining it. You're feeling the surface of something deeper. You are living through one of the most subtle transfers of wealth humanity has engineered, one that doesn't need riots, revolutions, or new laws. It happens in decimals and percentages. It shows up in your receipts and your bank balance. It has a name we've heard so often we've stopped treating it as a warning: inflation. Most definitions of inflation stop at prices going up, but that's like defining a storm as rain falling down. Technically true, but it misses what matters. Inflation rearranges who bears the burden of debt, who benefits from growth, and who ends up treading water. It doesn't just change how much things cost. It changes who buys a future and who rents one. For most people, inflation feels like instability. Prices feel out of control. Your savings account feels like it's leaking. The economy feels like a machine that's slipping out of gear. But if you zoom out and look from the perspective of institutions that shape the system, governments, central banks, major corporations, and wealthy investors, inflation isn't instability. It's management. It's how the machine is meant to run. Inflation is the tool that keeps a debt-based economy from collapsing under its own promises. It's how governments finance wars, bailouts, and stimulus without openly announcing enormous tax hikes. It's how corporations turn yesterday's dangerous debt into today's manageable liability. It's how those at the top, sitting on assets and long-term strategies, turn a predictable erosion of money into a predictable growth of net worth. So, the real mystery isn't why does inflation keep appearing? The real mystery is, why is the system built to produce inflation over and over, and why is that considered normal? To answer that, you have to rewind to an era in which inflation wasn't a target, but a danger. In the early 1900s, the monetary world looked very different. Major economies operated under the gold standard. Every unit of paper money represented a claim on a fixed amount of gold stored in a vault. Currency wasn't just a belief. It was, on paper, backed by a tangible, limited resource. This made money scarce and relatively stable. It also put a limit on political ambition. If a government wanted to spend more than it took in through taxes, it couldn't simply conjure up unlimited new currency. If it printed too much, it risked a run on its gold reserves and a loss of trust. Deficits had consequences. You either raised taxes, cut spending, or suffered a crisis. Inflation did exist, but it was usually short-lived and tied to extreme events: wars, crop failures, sudden disruptions. Persistent, deliberate inflation as a policy choice would have been viewed as reckless or dishonest. The mainstream view was simple: sound money is stable money. Then the world economy hit a catastrophe that sound money couldn't solve. The Great Depression in the 1930s wasn't an inflationary crisis. It was the opposite. Prices fell, wages fell, profits disappeared, banks collapsed in waves. What vanished wasn't just wealth, but confidence and circulation. People clung to their cash not because they loved money, but because they were terrified of tomorrow. In a deflationary environment, money becomes more valuable simply by existing. If $100 today buys more next year, the rational move is to hold on to it. But debts don't shrink automatically. A $1,000 loan doesn't care that prices are down 20%. You still owe $1,000. That gap crushes borrowers, especially when jobs are disappearing. The result is a brutal feedback loop. People spend less, businesses earn less, more businesses fail, banks see more defaults and tighten lending, credit dries up. The economy doesn't just slow, it seizes. The Great Depression burned into policymakers' minds a lesson. Deflation can be more destructive than inflation. That experience opened the door for a new way of thinking. Instead of treating inflation as the ultimate enemy, economists and governments began to see controlled inflation as a tool, a way to ease the pressure of debt, stimulate spending, and keep economies moving. By the time World War II ended, that tool was no longer theoretical. The war left advanced economies buried in public debt. Some governments owed more than twice what their countries produced in a year. There was no painless way to tax enough to pay that back. Defaulting would have shattered faith in the state. So, they embraced a quieter solution. Let time and inflation do the heavy lifting. During the post-war decades, there was real growth and reconstruction. But layered on top of that growth was a slow erosion of the real value of old debts. Government bonds issued in one era were repaid in another, in money that didn't buy nearly as much. Inflation operated like a hidden tax on holders of cash and fixed income assets, and a discount on the obligations of borrowers. The system had discovered something powerful. Steady, moderate inflation could repair balance sheets without riots, without headlines, and without clearly admitting who was paying the price. Then came a turning point that made inflation not just a side effect, but a structural feature, 1971. Up to that year, the world still technically operated under the Bretton Woods system, where the US dollar, the global reserve currency, was linked to gold for foreign governments. Other currencies linked themselves to the dollar, and the dollar linked itself, on paper, to gold. This kept at least a symbolic restraint on how far money could drift from metal, but mounting costs from war, social programs, and global responsibilities pushed that system to its breaking point. Foreign governments began doubting the U.S. could honor redemptions at the promised rate. They started asking for gold instead of dollars. In response, President Richard Nixon cut the link. He closed the gold window, ending the convertibility of dollars into gold. It was sold as a temporary emergency move. It became permanent. Overnight, the global monetary system shifted fully into fiat. From that moment forward, money was no longer legally bound to precious metal. It became what governments, central banks, and markets agreed it was. Its value rested on confidence, law, and the willingness of others to accept it, not on the promise of physical redemption. This change turned money into a more flexible and more dangerous tool. Once detached from gold, the potential supply of currency became limited mostly by political will and institutional credibility. Governments could borrow and spend on a scale that would have been impossible before. Banks could create credit through lending with far fewer hard constraints. The line between money and debt blurred. In this new world, inflation wasn't just a random consequence. It was a built-in outcome of how money and credit were created. And in that world, the old idea of saving as simply piling up cash became a losing strategy. We grow up hearing that debt is bad and cash is safe. But in a system designed around persistent inflation, the opposite can be true. Holding large amounts of cash means accepting that each year that cash buys less. Holding long-term, fixed-rate debt, the kind used to buy a house or a productive business, can mean watching the real weight of that debt shrink while the underlying asset grows in nominal value. $1 million mortgage scares most people at first glance. But if wages and prices double over 20 or 30 years while the mortgage payment stays the same in nominal terms, that crushing debt becomes relatively small by the end. The borrower is effectively paying it back with cheaper dollars. Meanwhile, the asset tied to that loan, the house, the land, the business, often appreciates. Maybe some of that is real growth. Maybe some of it is just inflation. But either way, the nominal value goes up. That's how inflation, the same force that erodes a worker's savings, can multiply the wealth of leveraged asset owners. This is the core paradox. The system that teaches ordinary people to fear inflation is the system that wealthier, more financially literate players quietly use to their advantage. There's no secret cabal required. The math does the sorting. Why keep this system? Because inflation is what makes a heavily indebted world survivable. Imagine a global economy full of mortgages, corporate loans, government bonds, credit lines, and personal debts, all denominated in a currency that never loses value. Every miscalculation, every crisis, every overreach would have to be paid back in full-strength dollars or euros or yen. Inflation softens that reality. It lets debts be repaid in weaker money, turning what would be defaults into manageable repayments. The cost is shifted to those who earn and save in that same weakening currency. So, what happens to the typical person? Wages move, but not with the same speed as asset prices or interest rates. Raises are negotiated, delayed, political. Many workers go years without meaningful increases. Meanwhile, the cost of housing, healthcare, education, food, and transportation can adjust faster, especially when money is cheap and credit is abundant. The result is a growing sense that you're working harder for less. Savings accounts, once the core of middle-class security, lose their old power. If the interest you're paid on savings is consistently lower than the rate at which prices rise, you're effectively paying the system for the privilege of not spending. You're being penalized for caution. At the same time, those who either start with assets or manage to acquire them early are playing a different game. A landlord can raise rent to keep up with inflation. A business can raise prices. A shareholder can benefit when companies pass higher costs onto consumers. Someone with a fixed-rate mortgage can watch their housing costs stay flat in nominal terms, while their income and the market value of their home rise. The system rewrites the rules of virtue. Thrift, patience, and saving were once reliable paths to security. In an inflationary, credit-driven world, those same qualities can leave you stuck. The new virtues are different. Take calculated risks, use debt strategically, buy assets early, keep cash balances low, and stay invested. There's another layer. Inflation doesn't spread equally. It concentrates opportunity. The people closest to the creation of new money, central banks issuing liquidity, governments running deficits, major financial institutions trading in bond markets, are the first to access that money. They receive it when prices are still low. They can deploy it into assets and markets before the rest of society has adjusted. By the time that new money filters down into wages and small businesses, the prices of key things, housing, stocks, certain goods, have already moved. This who gets the money first problem is the Cantillon Effect. Inflation doesn't just change how much things cost. It changes the order in which benefits and costs arrive. Centuries ago, the early receivers were kings and aristocrats. Today, they're central banks, large financial firms, and major corporations. Inflation lifts those at the top of the money pipeline long before it reaches everyone else. After 1971, with money unshackled from gold, this pattern became the baseline. Credit, not savings, became the central engine of growth. Governments and central banks realized that as long as inflation stayed within a politically acceptable band, they could manage debts, stimulate demand, and calm markets by adjusting interest rates and money flows. By the late 20th century, targeting inflation, usually around 2% a year, became orthodoxy. 2% sounded boring. It was described as price stability, even though over a couple of decades it means a dramatic erosion of purchasing power. A dollar saved at age 20 does not buy anywhere near the same amount at age 60. For everyday people, this shows up as a feeling, not a formula. Your parents or grandparents tell stories about what they paid for their first house or car. Those numbers sound tiny. One day, your stories will sound tiny too. The invisible bridge between those stories is inflation compounding year after year. But while the average consumer experiences this as frustration, the wealthy experience it as planning. If you know policymakers are committed to maintaining a positive inflation rate, and you have the means to borrow cheaply and buy assets that benefit from inflation, you're operating with a tailwind. Governments benefit as well. Public debts that look intimidating as raw numbers are less daunting when measured in future dollars that buy less. As long as economies keep nominally growing and inflation doesn't turn into panic, the real burden of old borrowing melts away. That's a strong temptation for politicians who want to promise more today and let future inflation handle the accounting. This is why deflation is treated as a dire emergency. Deflation reveals fragility. It makes old debts heavier, not lighter. It exposes which institutions, companies, and households are overextended. It forces painful corrections. Inflation, even when it hurts households, hides fragility by stretching it over years. Banks and the broader financial sector thrive on ongoing inflation. In a world where prices and wages drift steadily upward, it makes little sense to leave money idle. People are pushed, by reality and by marketing, to move savings into investments, retirement funds, real estate, stock markets. That means more borrowing, more trading, more products for banks to sell. Two families with similar incomes can have radically different outcomes under inflation, depending on how they use debt. One uses credit cards and personal loans to cover consumption. The other uses a fixed-rate mortgage and perhaps a business loan to acquire assets. On paper, both are in debt. In practice, one is being drained while the other is quietly being subsidized by inflation. Understanding this is one of the key dividing lines between people inflation crushes and people inflation quietly rewards. In 2008, the global financial system reached a breaking point. Years of easy credit and speculative bubbles imploded. Central banks slashed interest rates and created trillions in new money to buy government bonds, mortgage securities, and other financial assets. The goal was to prevent a deflationary cascade, collapsing prices, defaults, mass unemployment. They succeeded in saving the system, but not evenly. Asset prices recovered rapidly. Stock indices climbed. Real estate bounced back. Large financial institutions were rescued. Meanwhile, wage growth remained weak. The term quantitative easing made these policies sound technical. On the ground, they pumped new money into the financial system in ways that disproportionately boosted asset holders. Then came 2020 and the pandemic. This time, governments and central banks didn't just support banks and markets. They also sent money directly to households. At the same time, global supply chains broke. Factories closed, ports clogged. Certain goods became scarce, so you had more money chasing fewer goods. The result was a burst of inflation far above the 2% target. Again, asset markets rebounded. Stock markets hit new highs. Real estate got more expensive. People with assets and access to credit had another chance to grow wealth in nominal terms. People without those advantages dealt with rising rents, food prices, and energy bills that outpaced their incomes. Some commentators blamed this entirely on greed. Corporations, they argued, were exploiting the situation to raise prices more than costs justified, and some did. But the deeper story is older. When new money enters a constrained system, those best positioned to set prices and allocate capital capture more of the gains. That's not a glitch. That's how the architecture channels benefits. If you study history, you see the same script. Weimar Germany in the 1920s, post-war Britain, the 1970s United States, the 2020s worldwide. Different flags, different slogans, different leaders, same mechanics. Inflation is one of the most effective and least understood tools for redistributing wealth upward. It rarely appears as a line in a budget or a law to be voted on. Instead, it's embedded in the design of a credit-based system. We blame politicians, corporations, supply shocks, foreign conflicts, central banks, and each can play a role. But underneath is a simple reality. Our economic model is built on expanding credit, and expanding credit almost always brings inflation. The alternative is not a calm, fixed-price paradise. The alternative is deflationary collapse, a system in which debts can't be rolled over, banks fail in chains, and asset prices crash. That's why central banks will risk unpopularity to fight deflation and tolerate or quietly encourage moderate inflation. Publicly, they talk about fighting inflation when it spikes. They raise interest rates. They issue stern warnings. Markets panic. Politicians fret. But the real goal is rarely zero inflation forever. That would turn the gears of a credit-addicted economy in the wrong direction. The real goal is to keep inflation contained, high enough to ease debts, low enough to avoid revolt. Inflation doesn't just change balance sheets, it changes how people think. If your money will buy less next year, the incentive flips. Why hold off on a purchase if it will be more expensive later? Why leave your savings in cash if they will be worth less in 5 years? Inflation teaches people to prefer short-term gratification or speculative investment over long-term patience. It erodes the idea that you can simply work hard, save diligently, and be safe. It encourages risk-taking. Not always smart risk, just risk. It feeds bubbles because everyone is searching for something that might outrun inflation. It punishes those who refuse to play and rewards those who learn to surf the waves of credit and devaluation. Over time, this shapes culture. Constant growth as a non-negotiable good, consumption as identity, stability rebranded as stagnation. We call this economic expansion, prosperity, the market working. But the engine is the same. A cycle of borrowing, inflating, redistributing, and resetting expectations, with those closest to the engine capturing the largest share of gains. Once you understand this, inflation stops looking random. It starts looking like a clock, a way the system measures time in terms of power and control. Inflation rewards those who can think and act in decades. People and institutions that borrow long-term own durable assets, and influence credit conditions. It punishes those whose time horizon is the next bill cycle, wage earners, small savers, people living month to month. And it quietly erases the assumptions of those who still believe in the old story of safe money in the bank. That's why the wealthy don't simply fear inflation. They manage it, they hedge it, they design around it. In many cases, they depend on it. Each generation eventually discovers the same truth. The value of money is not fixed. It drifts. It's shaped by policy, crises, and decisions you never voted on. The critical question is whether you're positioned to be drained by that drift, or to understand and, to some degree, harness it. Inflation isn't a random curse that dropped out of the sky. It's the predictable outcome of a world built on immediate wants and delayed consequences. It's the operating environment of a system that uses debt as fuel. And here's the paradox. Take inflation away entirely, and the system doesn't gently stabilize. It violently contracts. Deflation punishes borrowers mercilessly. It wipes out leveraged players. It reveals which banks and corporations were only alive because inflation was slowly bailing them out. Trade slows, unemployment spikes, political instability follows. Inflation, for all the damage it does at the household level, is the grease that keeps the institutional machine from locking up. So, when you hear the phrase, "a little inflation is good for the economy," you now know there's a missing sentence. Good for which part of the economy? It's very good for heavily indebted governments. It's very good for corporations that can pass on higher costs. It's very good for investors who own assets that benefit from rising nominal prices. But for the worker trying to save for a home already rising faster than their wage, for the retiree whose pension is fixed while living costs climb, for the small saver who dutifully leaves money in the bank and wonders why life feels more expensive every year. For them, a little inflation is not a blessing. It's a slow, quiet tax with no formal bill. Inflation isn't a glitch on capitalism's dashboard. It's part of the software. Capitalism, in a leveraged, financialized form, running at full speed, with your labor converted into a currency that loses value as it moves. Because in the end, inflation isn't the spark that sets the system on fire. It's the oxygen that keeps that fire burning, and the economy we've built doesn't know how to survive without it. If this changed how you see prices, money, and normal economic headlines, hit subscribe. The present only makes sense when you understand the past, and history is full of clues about the game you're already playing.